The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. Investing involves risk, including loss of principal. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Advisory services offered through VestGen Advisors, LLC. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Oh my gosh, the Gulf of Mexico was just named the Gulf of America in the earnings call from Chevron. Nope, that's a true thing. It happened this week. What about the tariffs from yesterday? We'll talk about that more in the show. But how are you going to get retired and stay retired? The sole purpose of us coming to you every Sunday morning is to give you sincere and actionable ideas, the types of ideas that you can use to improve the lives of yourself and your loved ones financially. Because it's not just about amassing a pile of money. You got to find a way to turn that nest egg, that pile of money, into a systematic, repeatable set of passive income cash flows that can allow you to pursue life, worry less, and just, you know what? Live for fulfillment. You know, for me, that's a little bit of M&E, meals and entertainment, and maybe a little bit of less of travel and leisure. But hey, let's get started with a couple of things. You know, the first thing I'm thinking about is let's talk right away about this. What in the world is happening with the great rotation? Is it finally showing some legs? Is it real? Is it not real? This is all about your 401k, all about your IRA. Listen, the first month of the year, it's in the books, affectionately speaking. And the good news is the stock market, yes, that equity portion, your risk capital, it broadened out in the month of January. I mean, you literally had 10 of the 11 S&P sectors in the positive this month. And if you took a look at who the leaders were, healthcare, financials, materials, energy, yep, I said energy, that's a really good thing because it wasn't all about information technology. So the good news is in the month of January, this market rally really broadened out across all of the sectors. What's the bad news? Well, there's an old saying. I talk about these old sayings on Wall Street, you know, don't fight the Fed, new highs make new highs, don't fight the tape, etc. But flows follow returns. Flows follow returns, okay? And here's what I want to tell you. When prices of little loved stocks and sectors start moving, investors eventually start chasing the returns. But that's what's still missing because the fund flow, it's not going into healthcare, financials, industrial, energy. The fund flow, it's still going into technology because when I look at the month of January, there was more than $3.7 billion of new money put into technology stocks as measured by tech ETFs, only $1.8 billion in financials, so on and so forth. So what does that mean? I think it just means there's some hurdles to have this market rally be completely sustainable for the duration of the soft landing if we can't get the fund flow to follow these sectors that have underperformed the last couple of years. But I've mentioned to clients, hey, there's a reason not just to have cap-weighted indices. There's a reason to have what I call some equally weighted indices. But at least this, January, it was a good month. And remember, we talked about trader axioms. Well, here's another one. As goes January, so goes the year. You know what? If we can only be so happy, as goes January, so goes the year, because January was a positive month. So that just might indicate that we can have not one, not two, but 3 years of net equity gains. The issue is making sure that you're positioned for those equity gains in such a way that you don't get whipsawed if something bad actually occurs. Okay, now, taking all of that, I still think it's important that people focus on the ADRs coming out of the month of January. And when I say the ADRs, what I'm referring to is your asset allocation, your diversification, having very strong rebalancing protocols, and of course, good security selection. And from an asset allocation standpoint, I ask everybody, if you didn't do it at the end of the year, you got to do it coming into February. Look at your financial plan. And that financial plan should lead you to a concept, not of risk tolerance. Risk tolerance is how you feel, but that financial plan should lead you to a concept of risk budget. Risk budget is essentially your capacity for risk. How much risk, how much volatility, how much VIX can you experience in the totality of your portfolio while still being able to get retired and stay retired? Because remember, this might not be a 10-year thing. You could be retired for 20, 30, 40 years or more. We're going to talk about that in a later segment today. And once you understand that risk budget, don't stray from it. So if your risk budget says that you cannot be more than 70% in equity, I'm just making up a number. That's not representative of anybody. And all of a sudden you find out that your portfolio today has grown to 78, 80, 84% equity versus the 70% that your risk budget allows, you better find ways to rebalance. But then in that rebalancing activity, the question becomes, if you take money out of stocks, where do you put it? I mean, I do think there is great promise in the bond market, the fixed income market, because coupons are high. And when you can get high current income, it puts you in a place to help cash flow that retirement. But I think it's also an opportunity in 2025 for people to intelligently sell into strength, to bring that equity allocation back down to the proper risk budget, and allow those dollars maybe not just to find their way into traditional bonds and fixed income, but to find their way into the world of alternative investments. And whether we're looking at a new commodity super cycle that could be starting, whether that's the addition of precious metals, whether that's a small addition to virtual currency, whether that's an addition to things I talked about in last week's program, again, the worlds of private credit for those that it's appropriate for, the world of real estate for those who understand secure asset investing, for those who want to be involved in infrastructure. I think all of those are great opportunities that people can use to broaden their horizon, especially for those who are on the search for income. Because after spending some 16 years in this country at ZRIP, zero rate interest policy, and who didn't get excited about student loans being next to nothing, mortgages under 3%, yeah, bank accounts paid zero. But if you were retired, boy, it wasn't exciting buying any treasuries. But now in today's landscape, if you're using a sustainable withdrawal rate of 3, 4, 5% per year, you can generate income of 3, 4, 5% per year, which puts you in a position to win, the likes of which we haven't been able to do in the previous decade and a half. So here's what I think everybody needs to do. I just mentioned, as goes January, goes the year. There's a chance that's going to be part number 2. Celebrate the fact that in January, the market broadened with 10 of the 11 sectors in the S&P all trading to the positive. Yes, it wasn't all sunshine and roses because deal flow, money flow all came into tech compared to the other sectors, but that doesn't mean that pace is going to continue through the year. And if we see the flow of funds going into these other areas, then the durability, the sustainability of this stock market combined with an economy going to a soft landing, it puts us in a good place. Even if the Federal Reserve isn't going to give us any rate cuts, we may only get one additional cut this year, and it's probably not coming until July or September. But knowing that there are going to be cuts, that means this is a great time to be locking in yield. And if you want to build yield, you're going to go ahead and focus on that risk budget, the amount that your retirement plan allows you to have at risk in stocks. And you're going to take a look at rebalancing back to that risk budget, but incorporating alternative investments, not just fixed income, to broaden your landscape, because you want to generate the income, but you also want to have some things that can zig when other things are zagging. I think that's so incredibly important. And if you want to learn more, as always, you can. We love connecting with people from AM 560 The Answer, because you know what? Talk radio is not dead. I listen to it in the background literally 7 days a week. Why? I'm an information junkie, and I'll bet you are too. You just want to be empowered with education. You want to work with advisors that aren't into sales, but advisors that truly have the heart of a teacher. And that's just it. And maybe for me, that's what I consider myself, a fantastic financial educator who happens to be in the business of wealth management. How do you connect with us? Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Or pick up the phone and give us a call, 833-964-PLAN. That's 833-964-PLAN. I'm Craig Bolanos. I lead a team based in the suburbs, Inverness and Downers Grove, but we have clients in 41 states. We can help you craft a bespoke retirement plan that's going to help you worry less, live more, and most likely achieve what you want, which is to get retired and stay retired. How we're actually going to do that, we're going to talk a little bit about guardrails and other items coming up. So in the meantime, got to pay some bills, got to hit some commercials. You're listening to In the Know with Craig Bolanos, AM 560, The Answer.
With Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
Well, let's talk about how you actually start putting these plans into action. And there was news this week, lots of news this week. But one of the news that retirees pay attention to is Morningstar. That's the company that's long been heralded for rating mutual funds, exchange-traded funds, index funds, somewhat like restaurants with their 5-star system. However, what they talked about this week was, it was a little bit, disparaging. What they mentioned was that investors, or in this case, retirees, should plan on using a 3.7% withdrawal rate. Said another way, if you had $1 million in your nest egg, you would set up a initial cash flow of 3.7% of $1 million, or $37,000 per year, on top of Social Security, on top of your pension, whatever it might be. And when people saw that article, there was all this reaction, all this press, like, wait a second, what happened to the 4% withdrawal rule? What happened to the 5% withdrawal rule? Why is it only 3.7? And here's what I want to talk about. I think retirement planning shouldn't be static. I think retirement planning needs to be incredibly dynamic. We believe that people should be using dynamic withdrawal rates. And why should you use dynamic withdrawal rates? I mean, if your goal is to die with the most amount of money you've ever had at exactly the point in time you don't need it. Let me say it again. If your only goal is to die with the most money you've ever had at exactly the point in time you don't need it, then by all means, use a low static withdrawal rate. And if you invest superbly, that's probably what's going to happen. But I speak for me. I speak for my family. I think about our clients. You want to know what we want to do? We want to remain financially secure. We want to have the freedom from worry about money, but we want to enjoy life. We want to pursue passions. We want to spend $200 and $250 on a pickleball paddle if we want, because we think it makes us better. Probably doesn't, but it makes you feel good when you're out there pounding the ball. Same thing as when you're sitting on the tee box and you're like, oh, I'm going to crush this ball down the fairway. Nah, you know what? Your new driver, it allows you to do. It allows you to put it 2 fairways over or onto the road if you go over the trees. But here's my thinking. At our company, we believe, again, in dynamic withdrawal rates, and we do it with guardrails. You know, people don't know the amount of work product that's happening behind the scenes. It's having a dedicated team supported by our financial planners who go ahead and use what I call risk scoring or guardrails, right? And let me explain what I mean. There are so many advisors out there, and they're solely focused on the probability of failure in retirement. Like, what's the percentage of time or the probability that your plan fails? And when advisors work with clients on a failure percentage in retirement, I mean, obviously you want more success than you do failure. I think it creates anxiety, because if you hear the word failure, it's like, oh my gosh, once I retire, I might not stay retired. That's the exact opposite of what we stand for. And you know what? When people focus on the probability of failure, I think what's worse about it is it's wrong. I think what people can and should be doing is using goals-based retirement plans, cash flow-based retirement plans to create probability analysis, but then you implement it and you double check it with risk-based guardrails, because risk-based guardrails help us as advisors understand what could lead, not would, but what could lead to an adjustment in spending, and how that adjustment in spending could affect someone in dollar terms over time. It's kind of like a GPS for retirement. That's the way I explain it. So using dynamic withdrawal rates via the prescription of guardrails is essentially a GPS in retirement, because number one, it's about making sure you don't run out of money, hence our website. Get retired, stay retired. Number two, it's about having a clear path and a clear, systematic, repeatable process that's tested in the trenches to adjust cash flow over time. That means spending more when you can, or spending less if you must. And when you do that consistently through consistent behind the scenes testing, I think it gives you investment models that aren't just index-based, it's investment models that are fact-based on what you and your family needs. That's where we need to be. And if you want to learn more about dynamic withdrawal rates, guardrails, and moving past the probability of solving for failure in retirement, but instead creating a system that adjusts over time, that is consistently monitored, that allows you to pursue life, then give us a call, 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. You know, and let's go back, just talking about sustainable withdrawal rates. 2 weeks ago, I talked about whether the 4% rule still applies. You know, these are not rules that you should use, but they're starting points and guidelines to kind of check where you are. I mean, if somebody has a 40-year retirement, the amount of variability that could occur over 40 years probably means that starting withdrawal rate's closer to 3.1%. That's a mathematic thing. If someone's retirement's only going to be 20 years, using a starting withdrawal rate of 5%, probably going to be fine. If someone's talking about only having a time horizon of 15 years in retirement, a 7% withdrawal rate is probably fine too. It all depends. See, the longer the duration of retirement, the more variability of outcomes that can occur, both bad and good. So doesn't it make sense just to use dynamic withdrawal rules and guardrails so that you have a corridor of spending that can be accomplished over a period of time, and give yourself license to spend more when you can. Accept the fact that if it's responsible and if it's needed, spend a little less in a given year, because I don't want people to die with the most money they've ever had at exactly the point in time they don't need it. Oftentimes it ends up that way. I want people to live a life that is free of regret, because everybody tends to regret what they did not do much more so than the things that they did. Yeah, you know what? Let's sit with that for a minute. Don't we tend to regret the things we didn't do more so than the things that we did? I think that's a good axiom for life. And maybe what you should do is give us a call. 833-964-PLAN. 833-964-PLAN. Go out to our website, getretired.stay-retired.com. Download some of our guides. Subscribe to our weekly market commentary. You'll see everything we do in the media, from this radio station to the other radio stations to the TV appearances. I mean, just in the last couple of weeks, we've talked about the Social Security Fairness Act. We've gone ahead and discussed the tariffs. February 1st came and went. All of those things. 833-964-PLAN. Connect with us. Get retired. StayRetired.com. You know, speaking of markets, tariffs, all of these things, trade needs to be fair. There needs to be free markets. But from time to time, we got to take security, we got to take procedure, and we got to take protocol. I think it's paramount. And one of the things that's going to happen is business leaders, once they know the rules, they're going to find ways to adjust, because good leaders can pivot quick, scale fast, and execute well. And that's part of the reason I think people should continue to invest in great companies of America. It's no secret that we have favored US-based investments for investors. That doesn't mean you can't be globally diversified, but you should be grossly overweight the United States of America, because America is competing well. America is still the world's reserve currency. The dollar is still number one. The greenback is the world's reserve currency. And when you're in an environment that we still have good, solid consumerism in America, just look at the stores, look at the delivery trucks. When you're in a place, when you've got a low unemployment rate, when you're at a spot that the inflation, while it might be sticky, but the year over year change is under 3. I mean, we just got confirmation of that yet again this week, 2.8%. That's inflation under 3. That's a good recipe for a soft landing. But maybe we'll end up having no landing if there is intelligent policy, intelligent discipline, good fiscal constraint in DC. We could have another period of time where we just do in-flight refueling on this 747 and we keep on going. That's my analogy for the U.S. economy. So if you want to get retired, stay retired, it's not just about investing better. It's not just about tax planning that needs to be better. It's really about making sure that you have a set of guardrails in your portfolio withdrawal strategies to cash flow tax efficiently to generate that stream of income that you can't outlive. We want to help you do that. We do it well. 833-964-PLAN. Connect with us. Get retired. StayRetired.com. More to come. Craig Bolanos, In the Know, AM 560, The Answer.
Want more In the Know radio? You can't handle more In the Know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
You know, I'm thinking out loud. What I'm thinking about is this avalanche issue that remains in American financial planning. I call it the avalanche issue. Why? I discussed this with 2 clients this week, and those 2 clients are dealing with what I call a place for mom And in one of them, it was about a future place for dad. And it comes down to this conversation for all of us. If not long-term care insurance, then what? Seriously, if not long-term care insurance, then what? Seriously, this is the entire problem. The entire problem is fall risk is real in America. Yeah, you want to know what a problem for seniors is? It's taking a fall and all of the repercussions that come from fall risk. In addition to that, what I think happens, and it happens a lot, is people start this journey of care in the home, moving to assisted care, moving into some level of skilled nursing care. But you know what? It's all figured out on the fly, and the stress is more than palpable. And the challenge is often not with finding the care providers, not with this, not with that. It's the money every time. It's the money, it's the money, it's the money. Because you know the numbers. I mean, the numbers could be as little as $3,500 a month, $42,000 a year. The numbers can average $96,000 to $120,000 a year. We've seen care in acute skilled nursing facilities combined with Alzheimer's wards that can literally run the gamut of $180,000 to $240,000 a year. And I tell about my own story. I mean, my mom, she died of ALS, Lou Gehrig's disease. And that was in-home healthcare 24 hours a day, 7 days a week. And the bill, beyond extreme. Beyond extreme. It's no one's fault. It's just the marketplace. So here's what I think you got to think about. Yeah, I started the conversation by saying this morning, if not long-term care insurance, then what? And that doesn't mean a license for everyone to go out and buy long-term care insurance. But it's my reminder here on a Sunday morning that if you don't have a plan, you better get one. And let's talk about what those plans can be. You know, number one, we can self-insure. And you know what? I subscribe that some of our clients can and absolutely should be self-insuring the long-term care risk. Why? They've got great cash flow that could come courtesy of pensions, passive income properties, or very substantial, very sustainable retirement portfolios. They can self-insure. But for everybody else, and notice words that I used were substantial. Those are some qualifiers. But for everybody else, I think the solution becomes partially insuring. Yes, I said that, partially insuring, because where the industry has it wrong, where the sales agents has it wrong, is they want to sell you these big, gigantic, robust, long-term care policies, but they're unaffordable. And you know what? You don't need to insure against long-term care risk. You need to partially insure against long-term care risk. It's about taking the edge off, because if you have Social Security, if you have a portfolio, if you have equity in your home, if you have these things, then you can use those resources in combination with a partial insurance solution to make sure you're accomplishing what matters. You know, and here's what matters. You know, there was a time we're discussing the avalanche issue in American financial planning, which is long-term care, if you're just tuning in. But the avalanche issue today is financial impoverishment of the healthy spouse. So if you are married, what you have to worry about first is if one of you gets sick, and you know what you say to each other? Oh, it's never going to happen to me. And you say to your wife, you say to your husband, if it does happen to me, take me out in the backyard and shoot me. I mean, I'm married. These are the conversations we have. I got news. It's not going to happen. It's not going to happen. You're married because you love each other. I mean, I tell Leslie all the time, put me out on the lake, pull the drain plug. Let me go down. She's not going to do that. So when you're thinking about long-term care, if you are married, the first reason you're looking at it is you need to make sure that if you got someone you love and they love you back, you have a mutual responsibility to each other to ensure that the healthy spouse isn't financially impoverished if one of you develops MS, Parkinson's, goes through the shadows of dementia leading into Alzheimer's. All disease is crude. All disease is tough, but you got to protect for the healthy spouse. The second reason you're focused on doing some form of long-term care solution, self-insuring or partially insuring, which is what we're going to talk about, is you need to protect choice. You need to protect choice. What are the odds that you can find in today's environment a ranch home? Seriously, how often does a ranch home stay in the market? Gone instantly. Doesn't even hit the MLS. Happens in a pocket listing. Why? Everybody wants a first floor master. Everybody wants first floor living because of aging in place is what's happening. And let me tell you about protecting choice. It's age wave demographics. Look at the fact that everyone is getting older in this country. Look at the age wave demographics. Look at the baby boomers. Look at this wave of people that are coming through the system. We have limited private resources, maximum population, and all that does is drives up price. And if you want to protect choice, you're going to need to have some level of partial insurance to help you have that choice. And then reason number 3, to do some form of partially insured long-term care outside of protecting the healthy spouse, outside of protecting choice, it might just be leaving a legacy. It might be leaving a legacy. Because you know what? Whether it's anyone's fault, right, wrong, or indifferent, all of us want to see our kids do better than us. And that happens through the art of the dinner conversation. It happens through family values. It happens through traditional values that we pass on. But it doesn't hurt if the kids get a leg up and we can take some pride and leave them some money. But most importantly, we need to make sure we're not a burden to our kids. That's the reason long-term care is so important. And I think what we're going to do is we're going to take some time this morning and we're actually going to break down how to partially insure it, because I think that's important, because we've got information, we've got answers, and you deserve to learn more. And if you want to, you know what, pick up the phone, give us a call, 833-964-PLAN. That's 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com, because long-term care is the avalanche issue in American financial planning, and it deserves to be discussed. Now, when I think about solutions, we start with self-insuring, and then we move to partially insuring. And if we're going to talk about partially insuring long-term care, that leads us to solutions that answer 3 questions. 1, if I pay premiums, how can I make sure my premiums don't go up at a future date? That's really important, because you got to solve for premium risk. You want this policy paid up. Part number 2, if I don't use long-term care, how do I make sure that the premiums on the policy I invested in make it back to my spouse or make it back into my estate so it's not use it or lose it? Number 3, if I change my mind or I become financially successful and I can self-insure, is there an off-ramp at some juncture in the future so that I could cancel my policy and get my premiums back? And if that's the type of solution that you're interested in, that's the type of solutions that we're going to deliver. 833-964-PLAN, 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
So I want to talk about the Social Security Fairness Act, because again, if you're collecting a public pension, you can get full Social Security benefits now. This is a gigantic change. It is instrumental. It is monumental. It rolls back stuff that was put into place under Reagan a long time ago. And it's mission critical that you understand what that means for you, and it means for your benefits if you have a public pension that's non-covered and you're eligible for Social Security. This is key. So in case you didn't remember, we talked about this 3 weeks in a row. As soon as the news broke, on the way out, President Biden signed a bill. Yeah, it was a bipartisan bill called the Social Security Fairness Act. And essentially what it does is it ensures that if you're collecting a public pension, a non-covered public pension, that's a type of pension you've accrued when you weren't paying into Social Security at the time you were working for the public entity, there used to be these two offsetting programs, something called the windfall elimination provision and something called the government pension offset. But that law that was signed back in the 70s and 80s, the GPO and the WEP, it is now dead as of January 5th of this year, just last month. So what does that mean? Well, it means for about 3 million public sector employees, that could be you who's listening right now, you can expect a big uplift, but it comes with a responsibility of good planning, because what we'd been doing for decades just got upended. If you were a retired educator, retired firefighter, retired this, retired that. So there's information out there. You need to know about it. Google it. Better yet, call us 833-964-PLAN, 833-964-PLAN, and let's break down and talk about how the Social Security Fairness Act affects you, affects your spouse. Because remember, when it comes to things like Social Security, there is no room for selfish decisions. Now, does this just affect the 3 million people that I mentioned who have non-covered public pensions? No. It affects the other 330 million people who have to pay for this thing, right? You got to pay for this thing somehow. Now, all that's been done is we haven't raised any revenue to help pay for the new program. It's just going to deplete the Social Security Trust Fund 6 months earlier than it was originally scheduled. And that means we got to talk about the solutions that are going to be applied to go ahead and fix Social Security. And there was just a study done. It was just published. I saw it come across my desk on Tuesday. And it was a survey of 2,000 people, and it gave them choices on how to fix, how to plug the funding gap for Social Security. Because we all know there's a showdown here. The 2032 election is going to be about nothing more than Social Security and Medicare. But I want you to listen to what 2,000 people said should be done to fix Social Security. So the most common answer that the best way to fix Social Security is this: make rich people pay for it. There you go. Make rich people pay for it. The problem is, what's the definition of rich? See, a lot of people think they're normal. A lot of people think they're, middle class, upper middle class. A lot of people didn't inherit anything. A lot of people just think they're normal, next door neighbors. But the truth is, you look under the hood of this survey, and if you make more than $176,000, you know what everybody said? You ought to pay a lot more in taxes. That was the definition of rich. The second most common fix that was related to that was don't make the rich, make the wealthy pay a lot more. And how did they define wealthy? Someone who had total income that could be from work, pensions, dividends, capital gains, etc. Anybody who makes more than $400,000 should pay a boatload more. Now, maybe that doesn't affect you. Maybe it affects the boss that you work for at your small business. Maybe it affects someone in your family. Here's the bottom line. They defined rich as $176,000. They defined wealthy as $400,000 of income. But the most popular way to fix Social Security was clearly to make the rich and wealthy pay for it. And my point is, look at what the definition of rich and wealthy was in this survey. And it's going to ensnarl far more people than people actually realize. So what are you doing to put yourself in a position to be tax smart for the future? Yeah, I think that is so important, to be tax smart for the future. Oh, what were some of the other things that they wanted to do to go ahead and fix it? outside of taxing the rich, 176,000, taxing the wealthy, 400,000 of income, everybody was in favor of raising the payroll tax. So business owners, entrepreneurs, consultants, I got news. Instead of paying 6.2% employer, 6.2% employee, they just said, hey, you should pay 7.2% employer, 7.2% employee. So there you go, 14.4% tax rate for all the self-employed out there, taking money out of the independent business owner's pocket. And then, of course, people said, hey, if we were to raise revenue, not just to fix Social Security, which could be done with taxing the rich, taxing the wealthy that I defined, or it could be done with raising the payroll cap, it was asked, what if we did both? And if we did both, then we could increase everyone's cost of living adjustment in Social Security. And guess what? Everyone was unanimously in favor of that. So I think, all I'm talking about is we all know Social Security is going to have a shortfall. We just had this survey of 2,000 people across the nation. And what was their game plan? Oh, it wasn't to push back to retirement ages, wasn't to do this, wasn't to do that. It was just to raise taxes. What are you doing to make sure that when those taxes get raised, and they most certainly will, that you're not caught in the crosshairs? I think that's an interesting discussion. I think it's one that we should have together. 833-964-PLAN. 833-964-PLAN. Go to our website, getretired.stayretired.com. And speaking of taxes, I talk about this all the time. Everyone's single largest expense. You think at one point in time, it's the kids. Then you think it's the mortgage. Then you think it was the college bills if you chose to help out. And then you look at the avalanche issue in American financial planning that we talked about in the last segment, long-term care. But then you realize, no, there's one constant. Your single largest expense is today, has always been every day of the past, and will ever be increasing in the future. It's your taxes. So if you want to know what needs to be solved for in retirement, we talked about how to get retired, how to stay retired. We talked about how to use guardrails and dynamic withdrawal strategies so that you could live life, worry less, pursue more. The single biggest thing we got to fix in retirement is TIR, taxes in retirement. To the extent that you're not talking about TIR, taxes in retirement, then your retirement plans are falling short. I have a passion for this. My entire team has a passion for this. That's why we have been talking about Roth conversions before everybody was doing them. As soon as you had that glorious law in 2010 when you could spread the tax bill over 2 years, we cranked them out. Ever since we've been on AM 560, The Answer, going all the way back to 2013, folks, this is our 12th year. Lots of these financial advisors have come and gone on the weekend. We're here for 12 years. That ought to tell you something, because our models are sustainable. They're testing the trenches. But we've been talking about the tax bomb of retirement accounts for years. We embraced retirement accounts, but we embraced the strategies that we have been using to diffuse that ticking tax time bomb. So I want you to learn about solving taxes in retirement. I want you to learn about solving the ticking time bomb, where those 401ks, IRAs, annuities are definitively in the crosshairs, because they're viewed as low-hanging fruit by the taxing authorities. 833-964-PLAN. That's 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. I'm Craig Bolanos. We've assembled a diverse group of talented professionals that are multidisciplinary. That's investments under a fiduciary standard, financial planning under the CFP standard of care, tax, estate, and retiree health care. You put them under one roof, what do you get? You get a family office for everyone. That's what I invite you to experience.
Get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
A part of empowering you with information is this. I saved it for the end. Here we go. We got 3 minutes. Listen in. Turn up the radio. DeepSeek. DeepSeek. What happened? What are the possible implications? Let's hit it. What's DeepSeek? The buzz around the Chinese AI startup DeepSeek created all of this stir. I mean, huge stir. You saw all of our AI stocks get whacked. You know the names, NVIDIA, everything else, because DeepSeek, the AI chat box, well, listen, this thing, Chinese government state enterprise, theoretically only $6 million to develop and train. Oh my gosh, it's upended the hyperscale hundreds of millions and billions of dollars, maybe, that's been talking about this past week. And the impressive performance derived from less data, less power consumption is absolutely monumental. Now, because it comes out of China, it smells bad naturally, okay? I want to tell you that. It smells bad naturally. But maybe this is nothing more than the opening salvo of the change. We thought the United States of America was in the lead. We thought we were 6 to 9 months ahead of anybody, but the last administration, they didn't tighten our export controls close enough. And I think other countries like China, they used our IP and they might have just leapfrogged us. So what are the market implications here? Well, the sell-off you saw in that AI ecosystem, it really questions U.S. exceptionalism in the AI space. I think America is exceptional. I think we are the place, but boy, we ought to be a lot smarter on our export controls relative to our intellectual property, and this is a warning shot across the bow. So here's what's going to happen. The market's going to continue. It's going to parse DeepSeek's cost. It's going to parse their performance data. It's really going to look at all the latest developments on everything through OpenAI. You know, that's Microsoft. And I want people to understand when you're investing in innovation, which leads to disruption, it's fragile because new entrants into the marketplace can quickly cause disruption. And that's what DeepSeek might represent. So when I talked earlier today that market breadth is expanding, that we have leadership in healthcare, in financials, in industrials, in energy components, not just technology. And I talked about the need to be doing portfolio rebalancing. Never, ever, ever in my career, which has spanned more than a quarter century, have we seen such concentrated equity risk premium in just a handful of names in the S&P 500. And it does not mean the party is over, because the trend is still your friend, but the trend is in jeopardy because of what DeepSeek represents, which is a threat to upend AI domination through American companies. Want to learn more? 833-964-PLAN. GetRetired, StayRetired.com.